to be ample evidence that that is the case. So all we can do is continue to buy, knowing that it's undervalued, knowing that the market has already made gold a reserve currency, and by definition, silver will become a currency in due course.
Here's another thing that strikes me, I guess maybe the futures market, and this is, once again, going back to some that say that there's something wrong here. World silver production, Bart, is about 750 million ounces a day. And some days in the futures market, we may trade 1 billion ounces of, let's say, paper silver in terms of contract. So the paper market is so much larger than the physical market. Couldn't that create a potential problem? For example, when you hear a story like MF Global, which I want to get to in a moment, but if the paper market is concerned about counterparty risk and they say, you know what, I don't want this paper I'm owning anymore, I want the physical, what happens when there's so many more contracts, or the contracts are allowed to get in either direction, either on the short side or on the long side? They become so large that how do you deliver into that?
Well, a couple of things, Jim. One, and people don't realize this, but, the futures are always many times the physical. And it depends on what the commodity is, but I think the average, somebody told me, was like 10 times. So the futures trade at 10 times the physical on average. So there's not an equal number. As many people as want to trade whatever it is, silver or corn or oil, as long as there's people on each side of the trade, they can create futures contracts, unlimited. But secondly, you raise a point that I think is important, and I'm sad to say I think not looked at this agency as much as it should, and that is, what is the physical supply? You and I may be in the same age cohort. There used to be a television show, a sitcom called Chico and the Man, and there was an actor named Freddie Prinze who was the heartthrob of somebody I worked with. And Freddie Prinze used to say, it's not my job. It's not my job. And I think that's how the agency for a long time, Jim, looked at the physical market, that it's not their job, that it's just the futures. But they are integrally entwined, and unless we have that view, I don't think we're doing the job we need to do. So I've been a big proponent for ensuring that we are looking at the physical, despite what I said about how futures trade many times. And then the last point, Jim, real quickly, is that there are exemptions that have heretofore, these are exemptions from limits or accountability levels that have existed. These are accountability levels, what we call the back months, and position limits in the spot month. So we don't yet have position limits in the back months or aggregate position limits, but we do have currently in silver and in all the other markets that are traded, we have the spot month limits. But there's been exemptions to those, and those exemptions have been approved by the exchanges. And the exchanges, while I'm not saying they do a bad job, they have a different motive than we do in government as the regulator. They have a profit motive as opposed to just a good market motive and a good government motive. And that profit motive, I think, lends that exemption policy to sort of a more cavalier attitude towards granting exemptions. And here's the good news, Jim, finally, I'm making my point, is that we have changed that. No longer in the future will the exchanges grant any such exemptions. That the agency would have to grant those exemptions. I hope they'll be few and far between. But to your question about physical, that exemption, if we were to grant one, would have to be based upon the legitimate business needs. And that could include the physical, if it's silver or if it's gold or what have you, that the entity might hold. So they would have to, I've used it around here in the building, I've said they'd have to do it like Bruce Springsteen sings. They'd have to prove it all night. They'd have to prove that they need the exemption, and they would prove that, they could prove that through showing what they have in the physical. I'm sorry if that's such a long answer, but it's a fulsome answer, Jim, if nothing else.
Eric?
So, Jim, maybe I could comment here. First of all, I think you said we produce 750 million ounces a day. Yeah, and you meant 750 million ounces a year. And by the way, that points up a big difference, right? Because Commissioner Chilton said most commodities trade 10 times more than what's produced. On days when it trades a billion, it's trading, and I'm using a 250-day work here, by the way, or trading year, it trades 325 times bigger than what is produced. And it probably trades, if I was to do some quick math here, probably traded something like, let me do the math here, probably traded something like 1,300 times the amount of silver that was available for investment that day. 1,300 times.
Here's the thing that blows me away. Now, he's making a reference there that they're no longer going to grant these exemptions. So let's go back to 2 weeks ago, Eric, where in about a 10, 12-minute period, somebody sold 500 million ounces plus silver sold short. They must have got an exemption. And for what reason?
They didn't get an exemption. I'll tell you what happened. Subsequent to Commissioner Chilton's discussion with you, the reporting period for silver transactions was pushed out to June. I thought it was going to end at the end of February. From that point on, they had to report, what their positions were. But they made some rulings somewhere between January and February that people didn't have to report. They didn't have to begin that reporting process till sometime in June. So yet again, we have a regulator who's basically let someone off the hook. And, of course, my assumption is they probably said to these people, look, will you get the job done by June here? Because, if you start reporting and you're over the limit, we're going to have to say something. So why don't we just defer the reporting? And that decision, I think, was made about a month ago, if not maybe even 6 weeks ago. So that's why they didn't need to get an exemption.
Dave, he made reference to these new position limits that there are supposed to go into effect in June. So I would suspect the incident that we just saw 2 weeks ago, if those position limits were to go into effect, that would be prohibited. But what's to stop these entities from lobbying, because they do control the politicians, that there are waivers or the time frame gets extended further out into the future?
There is a possibility that the lobbyists would come in and, get the rules changed. It really might sound more positive toward the speculators or silver bulls, but really didn't do as much or have as much teeth as we'd wish. I want to drill down on what he said. He gave an answer. What he left out, in my view, is that what these exemptions all revolve around. They revolve around the spot month where the actual metal meets the road, excuse the pun. But let's go back to my little brief about the cattle market. The reason that the authorities came to Ken Robertson and said, what are you doing? You got all these positions on, was because it was in the front month or the spot month. And they were scared to death that someone might actually ask for what they bought. What a concept. Someone that buys cattle wants to actually have them, or someone that buys gold or silver or whatever. And that's why the exemption already exists. Now, he was hinting about this, but he didn't explain it. That the exemption that exists, again, is that you can only have 1,500 contracts in a spot month, 7.5 million ounces, which is roughly, 1/5 of the total combined inventory held by all registered dealers on the COMEX. So they are protecting themselves. That firewall is already there. And what happens as you get close and there's people that are not rolling their contracts over, in other words, they're not just playing the paper game, they're actually calling the bluff of the counterparty. In other words, a long is calling the bluff of a short in the spot month and refuses to roll over their contract for more paper, but actually sitting there and has the right to buy silver. Well, as long as that right is less than 1,500 contracts, then they can go ahead and execute it. Now, when that takes place, or I might say if, it has been my experience that they can receive a phone call. And the phone call basically is, why do you need it? What are you going to do with it? And this type of thing. This is, again, experience on my end. You can take it or leave it. You can use it as hearsay because I can't give you any written proof of that. The point being that certainly there's a lot of exemptions in place, but they always favor one side. They favor the shorts, not the longs. Now, what he was implying to me and what I've read and actually had an interface with him through one of my subscribers, it wasn't a direct interface, was that I think he understands what's going on and why the physical is so important. And I believe strongly that Bart really, really does want to have an exemption that works fairly on both sides. In other words, the shorts have to have X amount of physical to go short so much in the spot month. The problem is I don't know if they're going to do it in the back months. And that's where the real problem exists. Because as I wrote so long ago for you, Jim, I think the first time after we had our first couple of interviews, please write something about, the manipulation of the market. And I certainly don't remember the article exactly, but I remember the essence of it. And I said for a very long time, the market doesn't care what the buying or selling pressure is, because all markets move on either buying or selling pressure. And for a very long time, a huge amount of selling pressure on paper will take this market down over and over. But there will be a day where it does matter, and that is mattering more and more all the time. And I want to reemphasize the point that we talked about on your previous show that I was a guest, and that is how much selling was required. So if we reestablished the actual true amount that was sold on paper to take silver down $2.50 on that day was 550 million ounces, about, as you said, two-thirds of the annual supply of silver. That's what the requirement was to get it $2.50 down. And yet, if you back up a few months previous to that, when the Physical Silver Trust added 10 million ounces, it took the price up approximately 250. So again, I really want to emphasize for people that the physical actually has more effect on the market than the paper market. Why? Because the real market, the physical market, only takes 10 million ounces to move the price up 250, but the paper market requires 55 times more selling to take it down the same amount. So I really believe that we are on the cusp of seeing this market go the way I've always predicted, and that is there will be a day where the exchange or not isn't going to matter, that the physical market will take command, and there isn't a whole lot that can be done about it at that time. The problem is that the COMEX is kind of a showboat, showcase situation. Everyone focuses on that because it is the price-setting mechanism, and I understand that. But what a lot of people don't understand is that it's really a small player as far as how much physical moves around the world. Almost all of the silver, almost all of it, comes direct pipeline from the smelters to the silver users. And there's an association called the Silver Users Association that's existed for a very long time. And these silver users have a very nice relationship with the major smelting and refining entities worldwide. So they're not that concerned with having to get any silver from the registered dealers on the COMEX. That's almost a side issue. It's a sideshow for them. They've got their silver locked into contracts that probably have nothing to do, I should say nothing to do, but have something to do with the price. But these are contracts that are established on the over-the-counter market that really no one's privy to. And yet these hedge books that run all this paper games have basically unlimited access to sell whatever they feel necessary to put the market in a position where they want it. Let's say, for an example, and this is going off the radar a bit because this is not what I believe, but let's just say there was a collusion. And let's say that the edict was, we need to take the price of silver down $2.50 on this day. Now, I really doubt that that happened. I don't believe that that kind of a direct conspiracy exists. But let's just, for talking purposes, assume that it did. So the edict is, by the close, this market must be down at least $2.50. Sell as much as you have to get it down to that price. Well, we know what the answer is. You have to sell two-thirds of the world's annual production on a day to get it to move down that much. So, again, I think that we are in a position where those people that have been patiently waiting for the silver price to explode, I'm not sure it's going to explode at this point. I think this year it's going to edge up. I think it's going to be higher by the end of the year. I think we're going to be well over the $45 level by the end of the year. These things take time. But I don't want anyone to give up thinking that, the paper players control the market, because that's just not the case.
Dave, I wonder if there's an innate bias by government, because governments and central banks have always been concerned about inflation. So rising commodity prices, whether it's cattle, whether it's silver or oil, the government always gets concerned whenever a particular commodity market starts to rise. So there may be an innate bias against long positions that would move the price up, because that's going to move the inflation rate, possibly interest rates. So perhaps that's why they are so strict on your friend like Ken Roberts when he was taking a major position in cattle, or the Hunt brothers back in the late 1970s when they were taking a major position in silver. And then on the other hand, they are more lenient when it comes to short selling, because anything that drives the price of a commodity down helps on the inflationary front.
Jim, I agree. I think that makes a lot of sense, and I think that is part of the reason for the bias. You know, when the commodities market started, the intent was very, very